Hello and welcome to this 29th post of Investing Not Rocket Science. Investing doesn't have to be rocket science, and this is our non expert guide to portfolio management. We begin this post with a portfolio review. Since inception of the series, the portfolio is up 2.7%, while the benchmark is flat at 0.07%. The annualized return on this portfolio is 11.3%. In terms of risk measures, it has a Sharpe ratio of 1.06, a Sortino of 1.47, and a standard deviation of 0.41%. All asset classes have contributed to the positive performance of this portfolio. Before we continue, let's do a quick recap of this blog series so far. So Investing Not Rocket Science is a blog series that began in 14th February of this year. And the objective here is to build and manage an investment portfolio that will beat inflation and an equity index. The investment style that is presented here is active portfolio management. It's $1 million portfolio that will invest into equities and bonds. There is no use of leverage, and it has a time horizon greater than 5 years. The benchmark index that has been selected is the MSCI Investable Market Index. In post 1, I defined a basic portfolio framework. From post 2 to 20, I analyzed 67 stocks and 4 bonds. And this portfolio is long 15 stocks and 1 bond and is short 1 stock. From posts 21 to 27, it was focused around the quarter 1 earnings and economic data. The last post, which was 28, was focused around the Bank of England's interest rate decision, and also an evaluation of media and entertainment stocks such as Disney, Comcast, Paramount, Warner Brothers, and Netflix. In this video, we're going to look at a quick portfolio review and an update of the financial markets last week. Okay. In terms of the biggest gainers on the portfolio, it's Alphabet, which is up 31%, followed by Glencore at 11%, Tesla at about 6%, and ICBC at about 5%. Among the long positions, Deutsche Bank is the largest detractor with about 67% negative, followed by Citigroup at 9% negative. Also, our short position, which is Nvidia Corp, has gained 3.2%. So that's a losing position on this portfolio as well. Right. In summary, though, the portfolio continues to meet its objective by beating inflation and the benchmark index, and it does so with good risk measures. All right. In terms of portfolio allocation, the portfolio has about 49% or half of it in equities, 35% in fixed income, real estate, 6%, and 10% in cash. In terms of regional allocation, this portfolio is skewed towards Europe with 59% exposure. North America has 28% exposure, and Asia 13% exposure. Okay, there were no portfolio transactions last week, and we'll dive into how this portfolio performed last week vis-a-vis the benchmark. The portfolio is down minus 0.68%, similar to the benchmark. Portfolio detraction last week was largely due to the 35% weight we have in the UK Treasuries. Bonds fell as the Bank of England raised interest rates. BMW, Vodafone, and JD.com also saw some fall in prices, although JD did recover most of the fall during the week after it posted its result on Friday. All right, in terms of the gainers, Google was the largest gainer in the portfolio, and followed by Nvidia, which fell slightly and added to the positive performance of the portfolio last week. Here we go. We have JD.com. I'm sorry, this is ICBC, which is negative last week, 1398. 9618 is JD.com, and that is positive performance on the portfolio. Okay. Why was Alphabet stock up 10% last week? So according to an article in Barron's, Google was back with another round of demos and announcements at its developer conference last week in Mountain View, California. And this time the company got it right. Some of the key points that investors weighed as positive is Bard is now open to users in 180 countries. And while for now Bard is only available in English, it is expected to expand to 40 languages. Sundar Pichai and other presenters spoke of a bold and responsible approach to AI. This was seen as a positive by investors. Google will add a Help Me Write feature into Gmail. Maps will have an immersive view for routes that allows us to test drive or walk or run the routes um, before actually taking them. Google Photos will have a magic editor feature, and the company is also empowering Bard to provide images in response to queries. In terms of JD.com, which also announced its Q1 2023 results last week, according to a statement from the company, revenues were up 1.4% year on year at US dollar 35 billion. Service revenues were up about 35% at $7 billion. Net income for the quarter was $0.9 billion, so 900 million, compared to a loss of 400 million in quarter one in 2022. The company reports four segments. It has JD Retail, JD Logistics, Data, and new businesses. JD Retail, which includes JD Health and JD Industrials, among other components, mainly engage in online retail or online marketplace and marketing services in China. JD Logistics includes both internal and external logistics business. Dada is a local on demand delivery and retail platform in China, and new businesses mainly include JD Property and overseas businesses. All right, so what are some of the key highlights that JD looked at? The key highlights that were presented in the company statement. Tesla launched its flagship store on JD.com in the last quarter, offering auto products, charging equipment, and premium accessories. Also, was Longinus, the Swiss watchmaker brand, opened its flagship store on JD.com. JD Logistics opened its third self operating warehouse in California, bringing its tally to over 1,500 warehouses. Okay, let's look at what the financial markets were like last week. Equity markets were mostly negative. The Nasdaq 100 ended positive last week, mainly due to Google's performance. The Bank of England raised interest rates by 0.25% to 4.25. You can read about it in the last post. In the previous week, it was ECB and Fed, which also increased interest rates by 0.25%, and you can read about it in post 26. There was CPI data that came in last week from the US and German industrial production from Europe, and from China we have CPI data as well. China seems to be pretty close to a deflationary scenario according to its CPI data. Okay. In terms of economic data this week, we have European Union economic forecasts from the previous forecast, which was published in February of this year. The projections for growth were lifted, while the projections for inflation were reduced. This was seen as a positive. It'll be interesting to see what the European economic forecasts are going to be this week. There's going to be CPI and core CPI data for April from the EU area, China industrial production, UK employment, US retail sales and industrial production data, and home sales data. All right, that's about it from me in today's post. In the coming post, I will evaluate the Q1 earnings of the financial stocks in the portfolio and complete the assessment of the media and entertainment stocks, which we began last week. Okay, this is Investing, Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. You can visit the blog and join our mailing list on www.claritech.app, and we'll keep you updated of the latest posts. There's no subscription. This blog is free always. You can visit our social media channels. Please do subscribe or like. And please visit our website and read the terms of use. Thank you very much for watching, and I look forward to seeing you in the next post. Bye-bye.